Perfect. Good evening, everyone. Welcome to the Robinhood presentation. Tonight, we're going to walk you through the revenue models of Robinhood, our valuation of $20.40 billion of the company. We're going to talk to you about the company from both quantitative and qualitative perspectives, with our final recommendation to QUAAF, which is do not participate in the IPO or do not buy in the secondary market. Before I proceed to the presentation, I am going to spend 5 seconds to introduce to our MFin team here who have put this presentation together. So please, everyone, feel free to add us on LinkedIn or reach out to us through email. Moving on to the first and most important question. What is Robinhood? It is a theme as old as money itself, the struggle between the rich and the poor. And it became especially apparent after the financial crisis in 2008. While trust on Wall Street was the lowest, with millions protesting on the street, Robinhood rise in the shadow of the crisis, named after the English fairy tale character who took from the rich and gave to the poor. Robinhood is a cell phone trading app. It is a fintech company as its primary role. In addition, it has a dual responsibility as a financial brokerage firm. The future of this company will be determined by its integrity if it can hold the fort for retail investors. So how does Robinhood attract its customers? There's a zero-fee structure for equities and option trades, which has significantly lowered the entrance threshold for lots of people who have never had exposure to the financial markets. It is extremely easy to open an account and obtain margin, which would only cost $5 per month. All this packaged together have empowered 13 million people to gamble on the market without any confirmation of their investment knowledge. It is powered also by multiple product offerings, including crypto trading. All these retail order flows in the Robinhood order book then are routed and sold to market makers like Citadel, Virtue, and 2 Sigma, which is the core of their revenue stream, payment of order flow, PFOF. This is where 40 to 50% of revenue of the company comes from, which in 2020, just through PFOF, Robinhood has made $651 million in rebates. This is an extremely controversial revenue stream, where retail investors like you and me are subject to exploitations and information asymmetry. PFOF instigates conflict of interest between market makers and retail investors, where Robinhood is very unlikely to conduct its duty as a broker and to foster the best execution responsibilities. This means Robinhood is not able to guarantee the investor the best price available at the timestamp when you place your trades. However, no matter you're a Canadian investor sitting at home, going on BMO Investor Line, or TD Direct Investing, or Interactive Broker, your US order flow is very likely to be executed under the similar arrangement, which would the majority of the US order flows are executed these days. Well, let's talk about other revenue streams of Robinhood. This includes membership sales like Robinhood Gold, where retail investors are going to have visibility to level 2 market data, income from cash, where Robinhood can use the idle cash sitting in client's account to generate some income, and cash management, where Robinhood has its own MasterCard and debit card offerings. So if you're a typical retail investor sitting at home placing market or limit orders in the US market, what has changed for you? Now let's talk about how companies like Robinhood have disrupted the retail marketplace and changed the entire landscape. Because gamification features like encouragement of option trading through emojis and accessibility on the cell phone, which all of us are glued to these days, the typical users of Robinhood are around average age 26 to 31 years old, had little exposure to the financial markets. Accessibility to trading through technology is also another game changer. Imagine a typical retail investor who needs to log in online or call their brokers to place trades and inquire about their margin balance. All these are enabled with a clear visibility with real-time data on Robinhood app. As I mentioned before, the order flow data is a very precious commodity to market makers, ultimately to institutional investors. RobinTrack used to be a powerful public tool where all retail order flows are accessible online and everyone can see what Robinhooders and TikTok investors are up to. And this is the ultimate ecosystem that they have built and mastered that all the new generations of retail traders live in. In other words, Robinhood is an industry disruptor. Its influence has been further magnified by the COVID lockdown, when everyone stayed at home and glued to their cell phone and computer. The direct result is the increasing competition within the retail brokerage firms, which previously was a rather quiet corner in the marketplace. And firms like Charles Schwab and Morgan Stanley both acquire other retail firms to strengthen their presence in the market. Robinhood has received a lot of success so far until the recent GME scandal. Now I'm going to pass on to my partner, Stefan Yanyu, to talk about the Robinhood IPO.
Thank you very much, Cleo. Now, as we can see, our recommendation will be Robinhood is very likely to go in public this year. So the company has a plan to go in public starting years ago. So during 2020, Robinhood actively started interviewing banks for its IPO, and in December last year, Robinhood actually hired Goldman Sachs to lead the deal. So the company was planning to hold IPO around May before all this GME event happened. So we believe the company is very likely to go public this year based on a good fundamental and taking advantage of the fintech valuation frenzy. So from the performance perspective, it has a very solid performance as we can see from the top left chart. The PFOF revenue, which is around 40 to 55% of its revenue source, continued to grow in the past years. It also has a very steady user growth, as we can see from the top right chart. The Robinhood app reported an over 3.3 million download during last 30 days. So monthly download was up 175% compared to last month. So with the stay-home policy, Robinhood definitely has turned many people into investors. And then let's look at the Robinhood's ability to attract extra capital. We believe Robinhood recently shows its ability to attract extra capital even in this very controversial time. It received over 3.4 billion of capital injection from venture capital like Rabbit Capital and Iconic Capitals. Within the 3.4 billion, 2.4 billion were convertible notes, in which the investors, they would like to see the convertible notes to be converted into equity at a 30 billion valuation or a 30% discount to a eventual valuation at public offering. So this will definitely brings extra pressure for Robinhood to pursue its original IPO plan. However, the date, it may not be May, it could be delayed, but we believe it's going to happen this year. Meanwhile, Robinhood have multiple ways of going IPO. One would be going through the traditional initial public offering process. So the other one would be through a special purpose acquisition company is called a SPAC, which is very popular these days by high-tech companies. So going public will definitely provide a company with a new infusion of capital and allowed for easy access for future financing. But the final valuation will be subject to market condition, of course. Now, my colleague Johnson will be able to give you guys more details about recent GameStop event and how it actually impact our recommendation.
All right, thanks, Yanyu. So to begin with, let me just talk about what happened last week. So to first begin with, I'd like to introduce what's GME, the GameStop company. So GME engaged in the retail of multi-channel video games, consumer electronics, and a wallet service. Based on the fundamental analysis, this company was around $20 to $25 per share. But as we can see, based on the 52 weeks trading price range, GME was once trading at $483, and the lowest is $2.57. The trading volumes based on the last week is 200 million of shares trading on one single day, compared to average 2.5 million shares on every day. The short percentage floating shares at one time was 120%. Before we dive into the stories and players, let me just quickly go through what's short squeeze and what's gamma squeeze. So based on the demand and supply series, we know that price will go up with increasing demand. So the profit, so as we have seen, when more retail investors buy shares, the price will go up. So the profit from the long side investors will reflect the loss from the short side, which are normally heavily leveraged hedge fund, so that they will have to close the position by buying back all their shares to limit the loss. This their buying actions create a loop for shares to land on the moons, as we have seen. Second, what's gamma squeeze? Similar to the short squeeze, the investors bought unprecedented amount of call options, which means for the money maker, they sold unprecedented amount of call options. So to hedge these exposures, money makers will have to buy back. Again, create a loop for the sharings to go up, which I have seen land on the moon 2 weeks ago. Next, please. Now let's talk about the players on the stage. First of all, Wall Street bets, retail investors on Reddit. And they are the long holders, they're the long side. Who's betting against them? Hedge fund. We have seen Marvin Capital, Citron Research betting heavily against those retail investors. And those Wall Street bets using the Robinhood as their main distribution channel to buy call options, to buy stocks. And we know, interesting thing is, Citadel generate 50% of revenue for Robinhood through their business revenue models, which Citadel is also a friend of Marvin's. So, this created very controversial things and very interesting things to know. Now, as we have seen 2 weeks ago, the stock shares has goes rocket high, and hedge fund lost billions of dollars overnight. And how they fight back? Interesting, there's two stories behind those. One, according to Valdo, the CEO of the Robinhood, that he explained that Robinhood need to comply with the SEC regulation, which requires $3 billion of deposit, which we have no visibility or limited transparency, understanding where the numbers come from. So on that date, Robinhood limits the number of shares with only closing positions, only activities, was also published in the restriction list over dozens of companies, so that Wall Street bets investors and all the retail investors has limited and in a disadvantaged positions to buy those shares. Now, this is on the first day when they go up, and we have also seen the other brokerage such as Interactive Brokers, TDs, E-Trade, Charles Schwartz, all have taken the limited action against the retail investors. Move on to the next. So what's the potential impact of this event? First of all, it's from the SEC statement. As we can see, SEC announced their statement 2 weeks ago, publishing they're closely monitoring all the brokers if they're able to fulfill their responsibility and holding accountables. And they're going to protect all the retail investors to see if they've been put into disadvantaged positions. So that for the investors on Twitter, they're sharing their frustrated point of views. Some of them even filed a lawsuit against Robinhood. So I'll move on to pass on to how you talk about more about the lawsuit and the potential impact.
Okay, thanks, Joseph. So restricting buys on GME and several other stocks has already caused a 30 class action lawsuits on Robinhood. And CEO Vila to now need to testify during a GME hearing next week, along with the CEO of Citadel, Marvin Capital, and Reddit. Users are losing faith in Robinhood, and a campaign has been launched to delete the Robinhood app. Rating of the app lowered to 1 star. Google have to delete 100,000 ratings to salvage the issue. On the user numbers from their competitors, Weibo have grown 10 times since the start of this year. Robinhood is facing some other lawsuit problems previously. Last year, Robinhood has paid $65 million to SEC because they failed to offer best execution price to customers during the year of 2015 and 2018. While directing transaction to market makers, Robinhood is causing some delays in executing customer deals that enables Robinhood to earn profit from the difference in execution price. Robinhood neither admit or deny the issue. Instead, the 65 million are used to delay the lawsuit so that they could file the IPO. In 2019, Robinhood has been fined 1.25 million by FINRA for the same issue. One more lawsuit relates to suicide of Alexander Kearns, a young man who has accumulated 700,000 debt after his leverages transaction activities on Robinhood. Robinhood is lacking proper guidance and warning of the risk of leverage transactions. Those issues are not likely to affect the IPO of the company, but will cause negative social impact on Robinhood and will hamper the profitability and future performance of Robinhood. Next slide. Here's the valuation of, here's one method we use to evaluate Robinhood. The company hasn't filed any financial data or yet, so DCF and comparables method are not applicable. The first valuation method we use is based on revenue and user number predictions. User number of the company grows from 0.5 million to 30 million in 6 years, and revenue grow from 2.9 million to 200 million during the same time. The average valuation per user number and revenue multiplier is calculated. It is similar as the PE value. So, and that number is applied to the forecasted user number and revenue data. After that, 30% weight is allocated to user numbers forecast, and 70% is allocated to revenue forecast. And finally, a valuation of 16 billion is reached. Plus, there's a recent 3.4 billion capital injection from Rabbit that sums up to around 20 billion in 2021. Now, I will let Johnson to introduce another valuation method we use to value the company.
Thanks, Harry. So the second valuation method we use is comps analysis. So we're looking at our IBKR, CHARS, and TD Amateur Trading Holding Corporations. So the data we use as a comparison is daily average revenue trades, which is this industry-specific number, looking at how the company's ability to generate revenue from the tradings. And also we compare their revenues. We conduct to the revenue over our DARTs multiples, and based on the low, high, median. So also based on the Robinhood disclosed data in the latest quarter, the estimated average DARTs in 2020 is looking at 442 million of daily average multiple trades, and this implied revenue is over 5 billion, and multiplied by the company's industry average PE ratios, which is 4.2%. The implied EV is 20.4 billion. Now I'll pass on to Michael to conclude risk analysis.
Thank you, Johnson. So now to make it clear, from what we said, we do believe that Robinhood will keep its go public plans and is currently weighing an IPO or a SPAC deal. However, once it does go public, we do not recommend investing in this company because of the following risks. So first, let's talk about the social impact risk. As my colleagues have said earlier this month, Robinhood made itself an enemy of an army of retail investors, particularly those in the Reddit group Wall Street Bets. Now, through it all, one of the primary theories has been that Robinhood is working on behalf of the hedge funds. So the thinking there is that in order to keep the hedge funds like Melvin Capital, market maker Citadel, from losing money on their short positions, Robinhood banned its trading. Till this day, Robinhood has not completed any appropriate procedure to turn investor sentiments around. Those negative investor sentiments, they have not done anything to turn those around. But how about this? Let's give them the benefit of the doubt. But this theory is not true, and Robinhood is actually not working with hedge funds. But if that's the case, an even more serious issue arises. Vlad Tenev, who is the co-founder of Robinhood, unknowingly revealed in a Clubhouse interview with Elon Musk that the company does not have enough cash on its balance sheet. He said that during the GME situation, in the face of high customer demand and market volatility, the National Security Clearing Corporation, the NSCC, has asked Robinhood to put up $3 billion US as a sort of security deposit. Now, this requested amount was a lot higher than what the NSCC typically asks for. And because Robinhood did not have the capital, they had to place the trading limits to counter some of the volatility and lower the amount of capital it owed. Now, what this means is, in the end, is still that Robinhood chose to anger its customers, and did not choose to anger, say, like the NSCC or any regulators. And having angered its customers, it still has not done anything to ease those tensions. And in addition, if a similar situation happens again, Robinhood may need to restrict trading for certain stocks again because it does not have enough capital to cover that risk. Therefore, under the premise that other trading platforms like Webull, SoFi, or like Wealthsimple is a direct substitute to Robinhood, we foresee that these risks have a tremendously negative impact on its growing user base. So unless we are able to change the consumer sentiment, we do not recommend an investment. Unless they are able to change the consumer sentiment, we do not recommend an investment in Robinhood. So that concludes our Robinhood case analysis. Thank you very much for your time. If you have any questions right now, we would be more than happy to answer them. Thank you.
Thank you. That was a very good forensic look into Robinhood. We still don't know the outcomes of last month's episode. Now that GameStop has fallen back to its former levels, and it's not clear to me yet how all the margin money that went into purchasing options on behalf of its customers are going to be recovered. So a couple of timing things. The last $3 billion that they just raised in 2021, was that in direct response to this GameStop event?
Yes, I believe it is. And my teammates feel free to correct me if I am wrong, but because they had to put up more.
Yeah, just add some points to that. The 3 million they raised, actually, they raised that separately. They raised 1 billion at the date of January 29th. That's the Friday right after the Thursday event. I believe that kind of conversation does not happen overnight. So they must have already planned the raising money like beforehand, before the event happening. And then over the weekend, they raised another 2.4 million for I believe there are some impact based on the billion, sorry, yeah, based on the GME event, yes.
So it seems to me they're facing substantial credit losses in the execution of their customers. Now the next question is, you said they acted in favor of the hedge funds. Do we know if there's a conflict of interest in that the hedge funds are also owners currently?
Maybe I can take a stab on this question. So we do know that Citadel has a stake in Robinhood. So the role and the relationship, how it maps out. Citadel has a relationship which is also the market maker for Robinhood. So they absorb the order flow. So once they absorb it, what do they do? So they will discover the price, they'll execute it, or they have the opposite side of the trades. So they have the full visibility of the order flow, which means not only they have this retail flow, they have the retail flow probably from Webull, have many flows. So they are able to internalize that within their pool of trades at the lowest cost. So this is by all means a really win situation for Citadel just for Citadel. And this is a market condition that's built on the basis where it favors companies, big quantitative trading company houses like Citadel. Not to mention that Citadel also has a stake on Melvin Capital as well, which is the opposite side of the trades. So given all the situation, we do believe that Citadel has an interest in owning, has a stake and has an interest in Robinhood for sure.
Okay, thank you. And the $4 billion that you've now told me they've raised in January and February, do we know if that came from those specific hedge funds, or what was the source of that money?
Okay, in terms of the source, I can definitely take a look. Let me go back to the page. Okay, so 1 billion they raised originally came in from Rapid Capital and the Sequoia Capital, and then 2 days later they raised another 2.4 billion. They majorly came from New Enterprise Associates, Sequoia Capital, and other like index ventures.
Okay, so there's a potential conflict of interest for the funders. They're trying to cover their losses. Okay, and we still don't know the extent of those losses. When do they report?
Do you mean the
When do they report their financial results for the quarter ended, or that includes the January GameStop events?
they didn't file any financial results, but the fundraisings happened on January 29th, if that answers your question.
So, but they work on calendar quarters, I take it, so they won't actually be reporting till the end of April for a March program.
Right, yeah.
So, okay, so there's a lot of uncertainty around that. And the SEC, is it the SEC or some other securities regulator? You said they have some probes in right now about this. Who is responsible for managing the capital adequacy of this firm? Which regulator?
Maybe I can stab at this question.
Yep.
Yeah, sorry. So ultimately, as a brokerage house, Robinhood is a self-regulatory organization, which is SRO. Under the structure of regulation, this is under FINRA. So ultimately, FINRA has the duty of a regulation. It's a self-regulatory organization as a broker house, but it's FINRA. So on top of the FINRA, that's SEC. So that's how the regulation, how the structure comes through.
Okay, and I read somewhere that none of the deposits that they take in their money market funds are insured in any way. There is no federal insurance or otherwise on any of these funds. Is that right? Relating to the solvency of the firm itself.
Are you talking about like FDIC insurance
Yes.
kind of stuff?
Yes, or the equivalent of the securities industry.
I don't think we have that information.
I'm pretty sure it's not insured, so I'll just answer your question. So that represents another potential risk going forward of litigants in losses that they maybe thought that they were insured. Okay, that's my questions for now. Thank you.
Yeah, sorry, Peter, to add on top of your comments. So there are currently 30 more legal lawsuits lining up for the company. The last one cost was 65 million. So we are expecting a huge legal cost that's coming up this year.
I'm suspecting there will be more.
All right, thank you, Peter. Thanks, team, too. Great presentation. But do you want to go ahead with your question?
Yeah, so I have a question. First of all, great presentation. Thanks for outlining the social cost in your presentation. Really appreciate that. So my question was regarding the valuation, where you spoke about 70% based on revenue and 30% based on user-based. Yeah. So was there any kind of science behind getting to that number, or was it a heuristic number?
Can you say the question again? Sorry.